CEO of Crystal Energy. Carol, like every week, it seems much happening. We have warning, advance notice from the White House yesterday. They expect to see inflation numbers that are due shortly to be elevated again, I think was their word. Your thoughts on the sort of macro picture as it stands at the moment, with oil prices at near 13-week highs?
Good morning, Sean. Good morning, everyone. It's good to be with you again. Well, look, what was interesting yesterday, it was not just what the White House said, but it was interesting that over the last 2 days, we had back-to-back major publications, major statements by the World Bank, by the OECD on the economic outlook, and none of those portrayed a positive picture. On the contrary, there were significant fears expressed in terms of the economic outlook, and there is even the World Bank was warning of stagflation risk, where you'll have dampened growth and high inflation. And of course, they blame things on the war in Ukraine. Actually, it's entitled "The Price of War," the report was entitled, but also on the supply chain bottlenecks, which continue with us today, and the increase in energy prices and food prices. And if you look at the economic forecast, you can see how they revised downwards almost for all countries, except, of course, for the net oil exporters, particularly in the Middle East. So on balance, the picture on the economic front does not look very encouraging. But at the moment, when you look at these publications and forecasts versus what's happening on the ground with oil prices, for instance, you have the impression that there is some kind of disconnect between the two, because you would expect to have the fears of recession or stagflation or whatever to impact negatively on economic growth and therefore on oil demand and oil prices, but somehow the market has not factored that in, and we're going to be in between those two kind of camps, where the first camp of high prices is primarily because of no visible signs of demand destruction, and that may come at some point, maybe too late by the time we realize, especially if it's structural, but that takes time to be recognized, and supply fear shortages. And on the other hand, you have the bigger unknown, which is the economic outlook, the gloomier economic outlook. And at some point, the market will have to find the right equilibrium between those, because at the moment there is some disconnect between those two realities.
Let's go to Geneva, although I do believe Rustin Edwards is sitting in lovely Greece today. Rustin Edwards, head fuel oil procurement at Euronav NV. Rustin, I assume you are at what is the annual gathering, largest gathering of all people who love ships in Athens this week. An important week, because I wanted to get your thoughts on the granular outlook of an interpretation of the new EU sanctions vis-a-vis shipping coming out of Europe.
Well, Yazoo from Athens and Macedonia. So the sanctions are having impacts on a lot of different transactions and flows, and there's a lot of self-sanctioning that's going on. So you do have shipping companies that have taken a stance saying that they will not ship a Russian product, no matter if it's sanctioned or unsanctioned whatsoever. They will not go to a Russian port. You've got the insurance industry, which is also clamping down on what they can do. So a lot of the P&I clubs have already, they're complying with the EU sanctions, the UK sanctions, and so they're not supplying the insurance. And so you do end up in this strange market where you have people who can transport Russian goods because they're not sanctioned. They get a very high freight rate for doing it, yet they can't get any of the services around the ship's needs because nobody will touch their ship if they've loaded a Russian cargo, i.e. the ship can't get bunker fuel, the ship can't get lube oil, the financing gets frozen on the ship. So it does create a lot of bottlenecks around moving Russian products out of port. There are people who are still trying to take advantage of it. I mean, I think there's some headlines out today that ships that were involved in the Venezuelan and Iranian flow are now moving into the Russian flow. So there are already black ships out doing these trades, doing these activities. And I think that's the way it's going to rebalance in the future going forward. I think in the insurance side, most of the consensus is that it will become a nationalized insurance pool, which is generalized term that the seller and the buyer will cover the insurance costs of the vessel. And you'll use national flag ships, so there's no way that any of the outside financing can come in and sanction the vessel. So there are people who found workarounds about moving the oil and moving grain.
Let's welcome Mark Oswald, Chief Economist at Global Strategists Global Strategists, excuse me, not as one, but and one, ADM Investor Services International. Mark, we seem to be in a little bit of a battle at the moment between the idea of demand is still robust, and particularly with China reopening and under sort of the supply concerns and constraints from Russia. But the China recovery story, if you might just speak to that a little bit, it showed some very positive numbers for May coming forward and has given the market a lift. But if one takes a slightly deeper dive into the Chinese numbers, on dollar terms, they're up significantly because, of course, all commodities, which is their biggest imports, all the price of them are up substantially. So in dollar terms, big rises in China, but in terms of volumes, more or less same.
Yes, I mean, if it's not really ever wise to go into too much of a deep dive into Chinese trade data because they're very erratic from month to month. But I think in principle, what they show is whether one looks at the dollar-denominated data or yuan, export demand is proving stronger than people had expected. It's expected to tail off, but in volume terms, actually, it's far less impressive. Imports still weak. They may have been better than expected, but 4% growth really for an economy which has been, it's supposed to be gearing up in terms of infrastructure investment. Again, it's not particularly impressive at all. So it shows how weak domestic demand is. And overall, I think the picture with China is still very much what will the measures that the Chinese economy, the Chinese government has put in place really do to actually give the economy a boost. Because as far as I can see, in the second quarter of this year, you'll be lucky, regardless of what the official data is, if the economy actually grows at all from the previous quarter. So the picture in China is still quite, I wouldn't say bleak, but it's certainly not encouraging. And the only encouraging part, I think, at the moment is, of course, from an oil market perspective, is China is now the biggest refiner in the world. So getting the whole economy going again means that they can perhaps fill some of those gaps in oil products that we are experiencing a lot of problems with at the moment.
Would you then be indicating, Mark, that the market, the price of oil is getting ahead of itself because it seems to be a little bit euphoric on the sort of China opening after COVID lockdown? I mean, the fact you could go have a Starbucks cappuccino, yippee, let's rise oil prices $5. Is that a bit too simple?
I mean, I think there's an overemphasis on China reopening in the same way that for however many years it's been, we've had this overplayed focus on the Iran nuclear talks. Both of them are somewhat of a red herring in the bigger picture. I think the more critical aspect is how much this demand destruction we're going to get. The evidence from Europe, which is obviously closest to the Ukraine war, is that the high price of energy is really starting to create some demand destruction, as well as obviously the uncertainty wrought by the Ukraine war in more general terms. So, I think at the moment, probably we are, we're talking about the demand that is there at the moment is probably a little bit like when one looks at the housing market anywhere in the world. You still see demand remaining quite strong, but actually the market's already gone into a downturn. And this is the same sort of picture that we're probably getting in terms of the world economy at the moment. The picture is not as good, as it appears at the moment, and the impact we'll probably start to see, particularly in the second half of the year.
Yeah, we were seeing that, Carol, in the US now. New mortgages have sort of dropped quite dramatically. Your thoughts? You've been quite gentle on central bankers managing monetary policy in recent times over the last 2 years. And your thoughts where that's at now from the point of, we got this European Central Bank meeting today. They're expected to sort of join the 50 basis point crowd. Are they moving quick enough? Should they move quicker? Or do you believe they will indeed tackle inflation to the full velocity needed?
Yeah, Sean, before I answer your question, just want to, maybe there's something that Mark could comment on if he has more insights, but I read somewhere this morning that Shanghai is reintroducing some kind of permanent lockdown measures. So that is something that I don't know whether the market has taken that into consideration. But to go back to central bank's decision, you know, it's not like about being soft on central banks, but you do have to believe in something when you are in the middle of a chaos. And there are lots of unknown. We've seen things that we did not see before. We now at the moment we're focusing on the war in Ukraine, but mind you, commodity inflation started long before the war in Ukraine. And the central bank, yes, you may argue that they have maybe stepped in late, they were a bit late, but maybe they were hoping that the supply chain bottlenecks would ease, and that did not happen. And this actually, although not the central banker currently, but Janet Yellen admitted that she was pretty wrong in terms of price expectations and supply chain bottlenecks resolving. So it's really, I wouldn't say that they were soft or they should have been harder, because I don't think anybody appreciated the seriousness of the supply chain bottlenecks. And add on top of that the war in Ukraine, which took many around the world by surprise. On the ECB decision, everybody's expecting some tightening to start to kick in as of next month from July. But mind you, this is not going to be a major development, because if you look at the real interest rate in the EU, they are in the negative territory, whereas inflation is around 8%, which is quite high. For decades we did not see this kind of rate in the Eurozone. So in that respect, they still have a long way to go to be to really achieve the targets that they want to achieve. So whatever they do at the moment, yes, they do have plenty of room to make it tighter, but at the same time, maybe what's happening today with the market, with inflation, can be the solution that they are hoping for, and that would lead to the unfortunate but probably much needed scenario of a recession, to take the heat out of the economy without forcing it by the monetary policy to slow down.
Rustin, we do have a number of European countries already in heavy double-digit inflation, the Baltic states, and they are the ones who are in some ways being most vocal about taking on the Russian engagement in a much more robust way, and they are suffering in a way the most. But you have been calling, Rustin, for a while that this sort of other half of the year we are going to be moving into a very difficult economic period. My question to you, Rustin, on that is, how's your outlook evolving, and is it a slope on the other side of this peak, or is it a cliff?
Well, I've been pretty vocal on a Q2, Q3 recession, where you have a slowdown in Q2. Q3 is the official recession period, and I think that looks like that forecast is becoming pretty accurate from what I've been seeing. The markets are slowing down, high cost of energy, high cost of food, and you still have high cost of freight for a lot of consumer goods, which just keeps rolling into the prices. I mean, if you look at fuel prices today at $1,300 a ton for VLSFO, $1,500 a ton for gas oil, that $1,500 a ton gas oil translates not only into shipping, but into trucks, into inland transportation, into rail, and all that just adds up to more price for the goods, and the inflation keeps rolling forward. So I think there is, things are going to come off, and I'm a believer of a 2008 style collapse. I think it's about to happen. I mean, I would not be surprised to see Q4 crude at $30.
And we still have, Rustin, your thoughts on the sort of circling the square here, squaring the circle, that airports are full, people are going on holidays, car rentals are through the roof. I mean, there's twice as many jobs being advertised in the US than there are unemployed people. There does seem to be this weird duality in this moment.
Well, there is a duality in this moment, because I think what's happened with the labor markets in the US and a lot of developed nations is that COVID really did change how a lot of people want to work. I think there has been an acceleration in people who've retired and moved themselves out of the workforce. And so they're not there to fill the jobs that were there back in 2019, because they've had a change in perspective on life and how they want to live. So I think there's probably been a higher rate of people probably in their late 50s, early 60s who decided, you know what, I'm done, don't need to work anymore. I can retire. I will retire. They took buyouts. They took the savings from the COVID payouts and decided they're not going to work anymore. So there is a structural labor shortage in that regards. But that just adds to the wage price spiral, which then feeds into the whole inflationary argument.
Mark, your thoughts on that question, slope or cliff on the other side of whatever this is that we're rising up to? In 2008-9, the period that Rustin refers to, we saw crude peak at 147, I think, and then off the cliff on the other side. Your thoughts on the outlook?
I think the critical aspect in all of this, which no one really seems to want to talk about, is what COVID and the Russian invasion of Ukraine have done is to expose the fact that actually we haven't been investing in productive capacity. It's most obvious in the oil sector. We know that, for instance, 2011, 2016, upstream oil and gas investment was about 750 billion a year. In 2017, 2021, it was just 400 billion. We're paying the price for that now. We know that 10% of US refining capacity is gone. So what we've gotten is an unusual situation. We're now getting a clear build-up in inventories where the demand is already starting to fall off. We're seeing it particularly in the US in terms of wholesale and retail inventories. But at the same time, we've got these productive capacity constraints, some of them which were exacerbated by COVID. So we're net, and we've got, that's not only in terms of actual office space, machinery, etc. But it's also in terms of people, as Rustin said, because people have made different choices about the way they work. So we've got a very nasty cocktail at the moment, whereby we are going to see the demand destruction. And at the same time, it may not actually have that much impact on inflation, simply because the productive capacity isn't there. And that sort of implies that the sort of demand destruction we need to see to bring down inflation is actually going to be quite calamitous. If it is to bring down inflation, central banks can't do anything about this. I mean, the fact of the measures, and it should be fiscal and monetary policy working together, which sadly everyone seems to have abandoned, despite the close coordination during the peak COVID period.
Jay Powell, Carol, cannot go out to the oil field and drill a well or help drill some extra wells. But certainly Saudi Arabia and the UAE can. And your thoughts after their meeting last week, fairly minor incremental change to their numbers. What do you think it translates to into reality, and where do you think they can go vis-a-vis production capacity within OPEC plus?
First, I have to get something off my chest about the queues at the airport, because we just came back after a long week in Germany on Monday to the UK, and they send you to a family queue, and the queue was massive, but there were only 2 staff there. So I would be careful reading how to read the busy airport. It's not necessarily just a pent-up demand, but you should also see that there is shortage of staff to deal with that, and that is producing all these images that you are seeing at the airport of long queues and busy airports, etc. So that's one thing to bear in mind. On OPEC plus decision, of course, it was an unexpected announcement. On the day, some expected it because already we heard some softening in the tone of Saudi Arabia. And Saudi Arabia really is a de facto leader of OPEC or OPEC plus in general. And I think with their decision, if I look beyond the barrels that they are planning to put in the market, and you question their capacity, you can question their ability, but there are 3 things we have to take into consideration that for me highlight be much more than what's happening today in the market. That first of all, they managed to reestablish the kind of relationship, the conventional relationship with the USA. So they kind of scored a point in that respect on the geopolitical front. They also managed to keep Russia on board. If you may recall that there were some quotes that they were going to, people were saying, oh, OPEC plus is not relevant anymore. On the contrary, Russia, it would be very important for the longevity of the cartel and its influence on the market in the future. And I know I'm going to be sanctioned because I use the word cartel, but let's say this is a general perception. But thirdly, I think there is increasing now concerns about demand destruction, because at the end for OPEC plus, what matters I don't think market stabilization is really their genuine mission statement and then raison d'etre, no matter how much they will tell us about it, because it seems to be working only in one situation when prices collapse. But it's primarily the concerns about demand destruction. And OPEC, in particular Saudi Arabia, has been quite sensitive in terms of not killing the goose that lays the golden eggs. And demand destruction, the problem, you cannot really put your finger on it in the short term, because you have to distinguish between what is cyclical, so what is a reaction to price, and what is structural. And the structural side is the more worrying sum for big organizations such as OPEC, which is sitting on assets that will last decades, and they won't extend the shelf life of those assets for as long as possible. So if I put all these on balance, yes, you may think that they will not be able to produce that, but that will keep price level at a certain point, which will allow them to achieve all these three, I don't want to say targets, but their desires or their interest to be protected on those three levels.
Let's get the survey question and give the room a view here on this outlook, cliff or slope, or what's over the horizon. World Bank issued stark stagflation warning this week. What is most likely outcome in 23 for developed economies, or even Rustin, I should have said 22 as you've indicated, but nonetheless 23, recession, continued growth, or stagflation?
Sean, you need like a 1 and 3 on that one as well.
1 and 3, all together. Well, the good old-fashioned recession, you've got 2 quarters of declining growth, and then everybody's happy and you go back to work. Stagflation tends to be hangs around for a while, and that seems to be the warning from the central bank, or from the World Bank at least. This stagflation is going to hang around for a while rather than just a short recession. But welcome the room's view on that. Rustin, just picking up on obviously the noises you're hearing in Athens with all the shippers and so forth. Will we get some kind of a divergence? We saw with Iran, and to a lesser extent with Venezuela, those willing to sort of navigate around the sanctions, to play it on the edges of opportunity. What's your outlook for that and vis-a-vis moving Russian oil with uncertain paperwork, with the uncertain insurance, with emerging trading, small sort of mercurial trading houses in dark corners, that sort of alternative space can grow to facilitate this very big opportunity of 30-40% discounted Russian crude into Asia?
Well, it's already grown. I mean, it's become a very large segment of the industry at the moment, because you do have ships that are engaged in the oil flow. 3.6 million barrels of crude exports. It's all moving out. It's all going to different areas of the world, not going to Europe, and it's all being done on a waterborne trade. There's a lot of maneuvers that are going on to facilitate that flow. You have lighterages being done in non-designated lighterage zones or somewhere out in the middle of the ocean, so that they're outside of the prying eyes. But nevertheless, the oil's loading, the oil's moving. There are companies that are willing to take the ships on. You have national flagged ships that are making the moves happen as well. So they're not part of any sanctions regime. And voila, so the crude moves, the product moves. Products are always going to be the tougher part of that whole flow, just because the diesel and the naphtha that was produced out of Russia and usually exported into Europe for reprocessing or just for retail sales, there's not that many places for it to go. And so that's kind of where you have the bottleneck on the freight, is on the clean product side, not so much on the crude oil.
Mark, if we could get your analysis vis-a-vis where all things Ukraine are. Obviously, we've mentioned before you have that association with Poland, but where Europe is, the cracks that may or may not be appearing in the alliance. Macron kind of irritating everybody with his continued sort of appeasement of Putin. Where do you think that's going now, as we come out of a period in which it looks like Russia is going to essentially take that critical part of the country that they've been after for a while?
Well, I think the situation in terms of the war is it's very entrenched, and there doesn't appear to be any form of end in sight. Even if Russia does take the whole of the Donbass region, I still don't think that that's going to cool Putin's ambitions. So that leaves us with a long haul problem, which will basically divide up. re-establish some of the divisions within Europe. There wasn't really ever, other than the knee-jerk reaction, a really coherent strategy within Europe. To be honest, not even within NATO. It was, it appeared that everyone was being a bit more cooperative, but underlying everything are still those deep divisions. In terms of approach, in terms of just fundamental divisions. So those cracks will carry on appearing. I think the more critical aspect, which no one seems to be really talking about, other than in terms of the Russian military maneuvers, is Russia is running out of inventories of goods to supply, its agricultural sector, its oil sector, all the major parts of the economy. Its imports have collapsed. Now, at some point, that's actually going to have a very material effect. Yes, we could talk about there's going to be demand in Europe, demand destruction in Europe, both from the war and from high energy prices. But what we're not probably focused on, simply because we see the ruble going up through the roof, but that's because they're not importing anything. That's actually very bad news for Russia. I can see a situation where the Russian economy collapses by 20% over the next 18 months, because they can't import anything. Yes, of course, like as Rustin was talking about with the oil industry, there will be workarounds, but there's quite a lot of things which they won't be able to get. And at that point, that brings in a material change, which might actually change some of their strategy, simply because the Russian economy, then falls off a cliff. And to me, that is probably the most critical point, because what we've got now is a very entrenched war, which isn't likely to end anytime soon.
An entrenched war, Mark, that has depended, at least militarily, on the Europeans and the US providing weaponry to the Ukrainian army, and Britain being one of the at the forefront of that. Boris Johnson, who was getting a lot of credit early in this 100-day war to date, with being a fairly robust supporter on that military side. I'm wondering, from your assessment, his current wounds in terms of politically wounded in the UK, does that affect or will that reduce his ability to support Ukraine, or how do you see those two intersecting?
No, I don't think so. Because I'd sort of put that to one side, particularly anything to do with defence. The UK has always been a big defence exporter. That's something which all parties support. They support the defence industry. And the fact that Johnson is basically walking wounded really doesn't make a lot of material difference to that. The UK, this is something which has broad public support apart from anything else. So there's no win on that. There's no extra win on that for Johnson. And there would be nothing which would actually detract from those defense exports continuing.
Okay, let's give Carol the last word this morning. We're on the survey result, where the outlook goes. Stagflation seems to be the word of the moment. Maybe it's in its own echo chamber. We haven't heard it, we haven't used it in a while, so let's use it a lot. Carol, your thoughts on this upward movement? Obviously, this economic outlook that is still very prominent in the headlines, but yet in the reality of the moment, it looks like economies are still robust, still consumers are still consuming. Do you see that at some point? Do you identify a turn, a twist, a cliff, or a slope? Your thoughts?
All these outlooks, I can see where the survey results are coming from. It's interesting that recession got the least percentages. So maybe Rasta needs to improve his forecasting conviction to people. But all these forecasts, they come with, even if you look at the World Bank, they do come with if. So if this continues, if that continues, and this will be the likely scenario. But they make it very clear it's not a repeat of the 70s, for example, nor of the 80s, because the situation today is pretty different. And this is what gives you a little bit of hope, because even central banks, for example, they have been more careful than before, and their financial position is stronger. And the same thing for government. So that gives you a bit of hope in terms of, okay, would there be a room to avoid this kind of ugly scenario? But at the same time, you say that maybe those ugly scenarios, particularly recession, is what is needed today to slow down the situation without really causing massive pain and on the policy side. But I would like to add one more point to what Mark was talking about, the war in Ukraine, because whenever I hear about the war in Ukraine, it's all about what's happening now, whether there is going to be peace or not. But I'm thinking more about the refugee problem across Europe. You already feel, I mentioned earlier we're in Germany, but you can already sense, despite people being welcoming and supportive, you already feel some sense of concern. How long would those people stay in our country? What would that mean? Would they ever go back? Who's going to cover the bill of the reconstruction in Ukraine? Who's going to cover the bill of sending those people back to Ukraine and give them their lives back, especially if their homes have been taken away by the Russians? So these are big questions, and I think it will take time for us to digest and understand their implication, not only on the geopolitical front, but also on the economic front, at least in Europe.
Yeah, that's interesting. I mean, those issues, the refugee up to 5 million out, are now somewhat similar number internal, and big weeks coming up for NATO. Ahead of the NATO summit at the end of the month, as to whether they can get Finland and Sweden into the tent with the apparent obstruction of Turkey. But we'll have to leave it there. At the end of this week, oil prices trading above 123. They're at the highest they've been since that brief moment when the war started. They peaked up and came back down quickly again, but so they're at the high since that moment, and seem to be in a steady progression upward. And yet the outlook for economic growth is not positive. Let's just put it that way. Whether it's recession, stagflation, or otherwise, we'll have to see where that goes. Can all of these things coexist? High commodity prices and low economic growth. That seems to be the destination. Mark, Oswald, as always, thank you so very much. Rustin, who's dropped off, I think he had to go to a meeting. Dr. Carroll, thank you again, as always. Have a great weekend, if indeed it is, or the rest of your working week. All the best.